why the stock market still cares about inflation. It was a relatively interesting number. And let's get on to the first piece here, which will show you the headline CPI data and how volatile it's been over the course of the last year. Big rip higher to almost 10%, and then coming all the way off to 3% last month, up to 3.2%. Is it the first uptick that we're seeing in CPI, including food and energy? And that's a big piece, because we'll get to the core inflation in just a second that excludes food and energy. Is it the first uptick in a year? Yeah. Is that a big deal? Yeah, it is. But a lot of this was expected. Actually, the expectation was 3.3%. So not a ton to write home about there, and especially when you factor in food and energy. The reason why this CPI value is so volatile, much more volatile than the core inflation that we'll get to here in a second, is when you include food and energy, you're including those crude oil markets, those wheat markets, the agriculture markets that swing around so crazy. And you'll remember what else was going on over the course of the last year or so with the rise of inflation was the Russian-Ukrainian war, and how that was hampering supply of energy, supply of ags. And so the price variance of those commodities can really swing this CPI number. So it's kind of taken a back seat, right? It's still at 3.2%, higher than the 2% target. But if we get on to the next piece here, we'll see the core inflation, while it didn't top out higher than the headline all-encompassing inflation did, respectively around 6% here in core inflation, and then in the more inclusive CPI value around 9%. Didn't get as high, but it's been much stickier. It's not falling nearly as quickly, and not nearly as close to the 2% target that the Fed wants it at, as is that headline CPI number. Now, this was the piece that the market was really looking for. This is what the Fed has said they're looking to model interest rates off of. And then, of course, stocks will really move higher or lower dependent on those interest rates. And so what did we get here? Well, we had an expectation of around 4.8%. That's where we were last month. We got 4.7%. So really nice number to see, and if we get to the next piece, we'll see what the stock market did right off of this number. It was a short-term bullish reaction to the lower CPI print, if we can get to the next slide. We'll see how that changed throughout the day as stocks were up around 1%, looking at the S&P 500 here, and rose to highs on the session right after the number coming in at 7:30, and then you can see that rally in the first 30 minutes or so for the S&P right afterwards. NASDAQ took this very well as well. So did the Russell and Dow Jones. Green activity across the board there. But what we saw throughout the rest of the day was really interesting as markets digested this number further, because if you take a hard look at that core inflation that we were just looking at there, 4.8% last month, 4.7% this month, looking for a 2% target. Well, at that rate, we're going to be here for multiple years, and Fed Chair Powell has said, yeah, this is going to be more than a 6-month process. We're looking at, 6 to 24 months to get this inflation down to where we want it. And so short-term bullish action out of the stock market, great. Lower inflation, maybe lower interest rates. Fed Chair Powell is going to be happy with this inflation number. But what we saw throughout the day was stocks actually come back lower to around unchanged, some of them negative on the day. And interest rates that got slammed off of this number rallied all the way back, and the 10-year put in multiple basis points to the upside by the end of the day. And let's bring in the projection for the next Fed meeting. If we can go on to the next slide here, you'll see that short-term interest rates were lower off the number, and they were actually lower throughout most of the day. And what does this mean? Well, this means that the market is saying, okay, we went from 4.8% to 4.7%. The Fed maybe doesn't need to hike interest rates. The chances of a rate hike in September now less than 10%, and that was 22% a month ago, which you might say, oh, it was still more likely than not that they weren't going to hike. Well, the odds have been more than cut in half, and they're getting closer to zero by the minute, it seems. Now, if we go to the next piece, we'll start to look at the projection for interest rates on into the future. You see this 2-year rate didn't lose nearly as much ground here today, and then 5 and 10-year rates really didn't lose that much ground. But before we get to the Fed projections for next year, I do want to highlight the relationship that we're looking at, because maybe I'm taking for granted a little bit that rates lower off the inflation number, stocks higher off the inflation number. Why is that so? And then throughout the day, as interest rates, especially in the medium and long term, moved higher, why would stocks move lower? Coincidentally, well, stocks haven't really liked higher interest rates. Rates went from 0% to 4% in 2022, and that coincided with the stock market falling 25%, especially technology stocks that make up a majority of the top weighting in the S&P 500, let alone it's almost all of that NASDAQ now. They really don't like high interest rates. And so if inflation comes in lower and then interest rate targets come in lower because that lower inflation, stocks tend to like that. And you've seen the stock market bounce back this year because that red line, the 2-year interest rate, has come off a little bit, or has at least stayed flat, hasn't moved higher. Doesn't want interest rates to move higher, but rates throughout the day, especially 2-year, 5-year, 10-year, especially the 10-year and 30-year, actually moved higher as the stock market came back down to unchanged. And let's conclude this segment with the projections for next year, still looking at the bulk of projections coming in around 4% there. We're above 5%. And so the market's still pricing in interest rate cuts for next year here, but it's very indecisive. It's rare that we have, over the course of the next year of Fed meetings, everything from 3% to above 5%, where we currently are. And today, like I say, not maybe the next Fed meeting or the next couple of months, interest rates moving higher, but interest rate projections for a year in the future, multiple years in the future, definitely moving a little bit higher as that core inflation number down 0.1%. Very nice to see. But at this rate, going to need interest rates to be higher for longer, as Fed Chair Powell has said, and the stock market doesn't really like that so much, and so stocks will continue to stay tuned to future inflation numbers.